we're going to move on to Chapter 5, finally here. Let me see. Here we go. So in Chapter 5, we're going to I'm going to go back to using the PowerPoints a little bit more in Chapter 5, just because they're a little bit more useful than they were in Chapter 4. Chapter 5, we're going to talk about unemployment tax. So there are, and I'm sorry, before I get started, I just want to remind you, so I sent out a message about nothing being due this week, and that's not true. You've got, so your Chapter 4 assessment, which I extended for 1 week because of the technical issue that I had with it, that is due Thursday night. So just kind of a reminder there. I'll try to remember to send out an announcement on Canvas about that. I'm sorry. Just the assessment. Yeah. The homework was still due, but then there was a technical issue with the assessment. It was only showing one question when students would go in there. So because that didn't discover that until a couple days before it was due, I extended that. So that is due Thursday night. You can still do your Chapter 4 homework if you haven't turned it in yet, but it will be docked 25%. You'll have that penalty there. See if there was anything else I was going to say. I'm sorry, it's so hot in here. It's hot in here, isn't it? Yeah, so yeah, I'm like, why did I wear a sweater? Because my next classroom is freezing cold. That's why. Okay, so today we're going to start moving on to Chapter 5, where we talk about unemployment tax, and there are two parts to unemployment tax. There is a federal unemployment tax and there is a state unemployment tax. And so we're going to go through and talk about both of those. Now, these are taxes that, for the most part, are completely paid by the employer. The employee doesn't pay any portion of federal unemployment tax. In the state of Iowa, employees do not pay any portion of state unemployment tax, and in most states that is the case. But there are some states that do have employees pay some portion of the state unemployment tax. So we're going to go through those two types of taxes. We're going to start out talking about what we usually start out talking about in these chapters. What is considered wages for purposes of the tax, because as you recall, we've got our equation, our base times our rate equals our tax. So we have to determine what that base is, what those taxable wages are, what types of wages are included in that calculation, who is considered an employee, because these unemployment taxes only apply to individuals who are considered to be employees. So we have to go through all of those factors before we get to the actual calculations of these rates. We also have some specific issues with these taxes because there is a state unemployment tax, and because the state unemployment tax varies from state to state, we get some complications when we have employees who work in multiple states for the same company. So we're going to take a look at what the rules are for determining how those employees are taxed for state unemployment tax purposes, and some other specific issues that arise with regard to these taxes. Then we'll talk about the tax rate, this concept of a tax credit for federal unemployment tax. If you've read ahead in the chapter, you've probably already read a little bit about the credit. This is an area where a lot of students kind of get caught up. So I'll try to slow down a little bit when we're talking about this credit. It's a credit against the tax rate. It's not a credit against the actual tax, but it reduces, or it actually increases the tax rate. So we'll talk about that concept. And then if we've got time, we'll start doing some specific problems with regard to state unemployment tax as well. So that's what we're doing in this chapter. I do want to point out as well, since we are starting a new chapter, I've got a couple of websites that are highlighted under this chapter 5 articles and links. If you're interested in how federal unemployment tax came about, if you're a history buff and you like that kind of stuff, I've got a link here to the history of the federal unemployment tax and then some other explanation about federal unemployment tax as well. So just a couple of things there. Oh, those are alternative formats. So I don't know what those are. All right, so let's get started here. So our objectives for this whole chapter, I kind of gave you a rundown what we're going to do today, but for the whole chapter, we're going to describe the requirements for classification as an employer or an employee under federal unemployment tax. So we do this with every chapter because we're talking about different types of taxes we need to know that are applied to employees. We need to define what exactly is an employee. Lucky for us, that definition doesn't really change for purposes of unemployment tax. So we're just kind of mostly a review. Talk about as well, what do we define as taxable wages for federal unemployment tax? So remember, we've got to determine what our base is, multiply it by a rate to calculate what the tax is. So we have to identify what, as part of what is that base, what are wages. Again, lucky for us, it's pretty much the same definition as we went through for federal income taxes and Social Security and Medicare taxes. So that shouldn't cause us too much issue. And then we're going to compute the federal unemployment tax, talk about this credit against the tax rate, and any credit reductions that might apply. This is where, like I said, it gets a little funny because of the wording, we usually think of credit as this is something that is going to reduce the amount that we have to pay. We're getting credit for something. But then we add in there a credit reduction. So we're talking about a credit that reduces tax, but then we're talking about a reduction of the credit. So essentially that's an increase in the tax. So we kind of have to slow down a little bit and in order to grasp that whole thing. At least that's what I found in the past. I'm sure you guys will be the exception. This class will be the exception to that, and you'll get it right away. Get what I mean by it right away. We're going to talk about this experience rating system. This is what we use when determining SUTA tax rates. So we've got two taxes here, right? We got federal unemployment tax and we've got state unemployment tax. State unemployment tax rates are a little bit more complex. So for FUTA purposes, and you'll hear me say this FUTA and SUTA, Federal Unemployment Tax Act, SUTA, State Unemployment Tax Act. For FUTA purposes, our base is pretty much constant. One base that we're going to use for all of our employees, and our rate is also constant for each of the employees. So it's pretty simple to grasp there. It could vary a little bit if we have a credit reduction, but for the most part, it's pretty easy to determine our base and our rate. Now, for SUTA tax purposes, though, our base varies by state. Each state has its own tax base, meaning the amount that is going to be subject to tax, and the rate varies by company. So one company has a different rate from another company. So CPA firm 1 and CPA firm 2, even though they're both CPA firms, may have different tax rates. So it gets a little bit more complex because we have to look at things on a state-by-state basis for SUTA tax purposes. And we have to look at things on a company-by-company basis. This experience rating system is what is used to determine what this rate is by company. So SYST. So what this does, the rates there's a range of rates. Each state sets up a range of tax rates, but the range is determined by the state, but the actual rate within that range is going to be based on a company's experience rating. The experience rating is how much have they used the unemployment benefits? How many of their employees have drawn from the fund? How many people have made claims, successful claims, for unemployment benefits against their company? So this experience rating system is based on how much it's used. Kind of like insurance, right? If you have car insurance and you get into an accident, chances are your rates are going to go up because you're now going to use that insurance. So the more you use the more you have employees that use the unemployment benefits, the higher that rate is going to be. So that's what we're going to talk about here with the experience rating system used in determining employers' contributions to the state unemployment compensation funds. And we're going to look at the reports and the due dates for those reports, as well as the due dates for deposits. So for FUTA, we have this, it's called a Form 940, and it is filed annually. So it's pretty simple, once a year. It's always due by January 31st for the previous year. But our deposits, we have a schedule, and that varies based on the amount due. So just like with the Social Security and Medicare taxes and income taxes that were withheld on the 941, just like the more a company owed in those taxes, the higher that liability was for that pay period, the more frequently they had to pay. The same is true for FUTA taxes. Now, luckily, it's either you pay it quarterly or you pay it annually. So we only really have two choices. We don't have that semi-weekly option or next day deposit option or that kind of thing. But we do have to talk about what the schedule, that's with an E or with an L, is for both the report that we have to file, and we're going to look at what the report looks like, and then also the deposit schedule for the amounts that are due. And then for SUTA, we'll do the same thing. And we'll look at Iowa here. So the Iowa, and I can't remember what the form is off the top of my head. It's like a 5-digit number. So this is the agency that oversees state unemployment in Iowa. It's called Iowa Workforce Development. So employers will file quarterly reports to Iowa Workforce Development indicating where the calculation is done of how much their taxes are, how much is owed in unemployment taxes, state unemployment taxes. So this is due quarterly. And then we'll also look at the deposit schedule, which I believe is still due with the report. But we'll take a look at that form and what it looks like and the information that is contained on that. So that is our summary of what we're going to do here in this chapter. Any questions?
Yes. Okay, so with FUTA, you do the 940 annually. With SUTA, there is no form.
Well, for SUTA, it's going to vary by state. There is a form. Iowa, I don't know the number off the top of my head. When we look it up, we'll get the number of the form. But it is filed to Iowa Workforce Development. So there is a report that is due on a quarterly basis to the state of Iowa or Iowa Workforce Development. And then the payment as well, I believe, is still quarterly, could be monthly. I'll have to get updated on that. But there are both report and report schedules for both types of taxes, and then there are also deposit schedules for both types of taxes. Okay, so why are we collecting these taxes? So the federal unemployment tax, the taxes that are collected for federal unemployment, obviously they go to the federal government. The federal government oversees all of the state unemployment agencies, and they approve the unemployment regimes in each of those states. So the states put together their own unemployment tax system, but that has to be approved by the state, and it has to be approved by the federal government, and it has to be administered by the federal government. So FUTA, federal unemployment tax, what it does, it collects the taxes essentially to pay the administrators to administer the program. So it's really like 100% just toward salaries. Salaries that then pay for, amounts that pay for salaries for people who administer the program within the federal government and oversee it. It was started in 1935, so again, we've got one of those Depression-era acts that was put in place in response to the high unemployment that was experienced due to the Great Depression. It was another one of those social programs that was implemented. So it is based on, our base is based on wages that the employer pays. It is 100% paid by employers. Employees do not have any amount withheld from their paycheck for federal unemployment taxes. It is 100% paid. Now, wages are probably slightly lower as a result of this tax, because if the employer is paying this amount in tax, that's money that they're not paying some other way, but there is no direct payment by employees toward federal unemployment. SUTA is the state-by-state program that is run by each of the states, and every state and all of the territories have a state unemployment agency. The benefits that are paid for unemployment come out of the SUTA funds. So each state collects taxes from employers. Those taxes go into a trust fund, a big pool of money, and then all of the benefits that are paid out come from that trust fund. So in order to receive benefits, individuals have to be unemployed for not everybody that's unemployed is eligible for receiving benefits. You have to be unemployed due to no fault of your own. So you can't just quit your job or not show up and get fired and then collect unemployment. It has to be through no fault of your own. So if you are laid off, or if the business closes, or if you quit because of certain other say harassment or something like that, where you're in a hostile work environment, if you can prove that that's the reason that you had to leave, then you may be able to collect, employees may be able to collect unemployment in those instances. But the amounts that are collected are then, for state unemployment, are used to pay those benefits to recipients of unemployment. Now, like I said, it varies from state to state, and every state has their own system. Every state has a different tax base, a different amount of wages per employee that is subject to tax. Every state has a different range of rates, and then every company has a specific rate that is assigned by the state. That is, like I said, based on this experience rating system. Puerto Rico, Virgin Islands, District of Columbia all have unemployment compensation laws. They all have to be approved by the federal government. So each state has presented their unemployment plan, and it has been approved by the federal government as being acceptable, meaning that they're okay with the base that's used, they're okay with the rate that's used, they're okay with who is receiving the benefits, right, or who is not eligible to receive the benefits. So who is covered under FUTA? Well, actually, this is for what employers are required to participate and pay the tax, the FUTA tax. And for the most part, if you have to pay FUTA tax, you also have to pay SUTA tax. So employers have to pay this tax if they pay wages of $1,500 or more during any calendar quarter in either the current year or last year. So that's a pretty low bar, right? $1,500 per quarter, and that's wages, not taxes. Remember when we were talking about the 941 and whether the frequency of making those deposits for income taxes, Social Security taxes, Medicare taxes, that was based on how much tax was owed. In this case, this is based on how much in wages were paid. So did the company pay $1,500 or more during any calendar quarter this year or last year? Or did they employ one or more person on at least some portion of one day, even if it's only 30 minutes, some portion of a day, in each of 20 or more calendar weeks during the current or preceding taxable year? So, and the 20 weeks don't have to be consecutive weeks. So if you could employ, if you employed and it doesn't have to be the same person. So if I employed Regina for one day in January, and then I employed Alyssa on another day in February, and so on and so forth, or even just for an hour or two during those days, if that adds up to 20 days, then I'm liable for FUTA taxes. Then I'm an employer with regard to FUTA taxes. It doesn't have to be for the whole week. What a calendar week is defined with Sunday to Saturday, by the way. So if it was, you employed somebody on a Sunday and a Wednesday, that's just 1 week. Okay, so it has to be those. That's how they define the calendar weeks. So probably the vast majority of employers would fall under that umbrella. It includes regular, part-time, and temporary workers. Employees on vacation and sick leave would still be considered working, and they would be covered under FUTA as well. Partners in a partnership are not considered employees. Just like for Social Security, Medicare tax purposes, partners were not considered employees. For FLSA purposes, they weren't considered employees. For federal income tax purposes, they weren't considered employees. For FUTA and SUTA, they're also not considered to be employees. Okay, so if you're not an employee, then your wages aren't included here, and there's no tax, there's no unemployment tax that has to be paid for any amount of payment to those individuals. There are some special rules for agricultural household employees, but I'm not gonna go through those specifically. I think your book may go through a little bit more detail about those. Now, so that's who an employer is. Who is, as an employer, is required to and subject to this tax or these taxes. So who is an employee? Again, it's only employees. Independent contractors, not included in this, right? Independent contractors also are not included. They're not beneficiaries of unemployment. They can't file for unemployment. There was an exception made during COVID for, I don't know how long that lasted, for independent contractors. Yeah, so there was an exception. That was the first time that had happened, though, and it no longer applies now. It's back to you have to be an employee. But there was an exception. There was an exception as well as far as the federal government was directly paying benefits in addition to state benefits. So, and that was the only time that has happened. That is not the case anymore. That was a temporary benefit. So again, we're going back to that common law, that whole common law relationship. So if, generally speaking, if the employer has the right to direct and control an employee's activities, then they're considered to be an employee, and their wages would then be included in the base for purposes of calculating how much tax is owed. A couple of areas where it's specifically included, even though there may not be that control factor there: agent drivers, commission drivers for food, beverage, or laundry, and then traveling or city salespeople. Very specific situations. There are some exceptions, though, as well. So casual laborers, day laborers, would not be included in this. So these are people who are just working for, one day, they're being hired for a specific job on that day. So casual laborers. Again, partners in a partnership are not included. Also directors. So individuals who are on a board of directors are not considered employees for purposes of federal unemployment tax. Also, foreign students and exchange visitors would not be considered, would not be covered individuals, so their wages would not be included in that calculation. So generally speaking, if you're covered under FUTA, you're also going to be covered under SUTA. So if you're an employer that's required to report under FUTA, chances are, you're also going to be covered, have to pay SUTA taxes. Each state would have some kind of their own rules regarding that, but for the most part, if you're covered under a covered employee under FUTA, you're a covered employee under SUTA. So to determine exclusion, if you're excluded from SUTA coverage, if the employee is free from control or direction, again, they would probably most likely be considered an independent contractor in that case. If the duties are performed outside of the usual course of business, then they might be considered an independent contractor. In that case, they wouldn't be considered an employee. So, and for individuals who are customarily engaged in independent trade or business, they're sole proprietors or they've got their own business, they're not covered under SUTA or under FUTA. Okay.